Equity futures taking a breather after hitting a fresh record 30 minutes ago until the official start of trading. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, earnings season picks up with reports from Tesla and Alphabet on the horizon. Meanwhile, you have Treasury Secretary Scott Bessent offering support for Jerome Powell, saying that he sees no reason for the Fed chair to step down now, and railroads could be taking another crack at M&A. Details on those deal talks ahead. Sonali, what do we have under the surface here?
Earnings season. We're looking at some of the defense companies. Lockheed Martin down almost 7% pre-market. And of course, you're looking at them missing expectations as well as reporting a pretty significant loss here tied to results. Katie, I think you're also looking at General Motors.
Yeah, let's talk about General Motors. This was a really interesting one. Of course, you had GM come out and say that they expect an even bigger hit than was expected from tariffs to the tune of about $1.1 billion. They actually beat on several measures when it came to this earnings report, but you can see shares down 1.7%.
We're going to now bring in Bloomberg stocks reporter Nora Melinda. More on defense earnings this morning because unlike Lockheed Martin, you're seeing Northrop Grumman rising. And perhaps explain here, Nora, the tale of two cities we're looking at.
We're definitely seeing a tale of two cities, as you're mentioning today. We're seeing shares of RTX. Now, this is one of the biggest U.S. defense contractors that we track, Lockheed Martin being the second biggest here. And we have Northrop Grumman. We are seeing that in the green. And this is, of course, after we got results today that it boosted its full-year adjusted EPS forecast. But we are seeing shares of RTX and LMT both lagging this morning. And that's after they had earnings that missed expectations. But coming into this earnings season, we were seeing a lot of the street a little bit pessimistic, if I will say. They were expecting that this would be the reaction, that either we would see shares trade flat or we would actually see them trade off, because of course a lot of people are thinking about the defense space and as we're thinking about the budget in regards to the Department of Defense and a lot of these other headwinds that we've been seeing the sector dealing with when it comes to supply chains and all these other aspects here. So not a surprise with what we're seeing in terms of the share move in this pre-market trading, but definitely interesting when you're seeing Northrop Grumman breaking out here.
It's also unintuitive to the casual follower of defense names. You would think that these are the sort of companies that would be in the spotlight that might be benefiting from the currently fraught geopolitical environment we're in. You think about what's happening with European defense companies. They've been absolutely skyrocketing. It's a more nuanced story when it comes to American defense.
Absolutely. I mean, we did see, of course, all these geopolitical tensions that you would anticipate being a tailwind for defense, but we do have the street. I mean, we can't say that these companies are really doing poorly this year. We are talking about stocks that still remain in the green. But if you look at the broader defense and aerospace industry more broadly, we are seeing a bifurcation here. You're seeing aerospace stocks really driving the rally in that sector, and you're seeing these U.S. defense contractors lagging behind here.
All right, Nora Melinda, great reporting as always. Keeping an eye on Lockheed Martin and the like. And staying on earnings, Dutch semiconductor designer NXP gave a weak forecast over concern that auto sector disruptions will hurt revenue. We're also looking ahead to Google earnings tomorrow as Google notches up a really impressive win streak. Let's bring in Bloomberg Tech co-host Caroline Hyde with all the details right now. And I guess we start with the bad news. NXP Semiconductors really taking a hit this morning.
It is, and it's because they didn't quite live up to the highest of expectations. And I'm afraid in this current environment, if you're not going to be meeting the street expectations, even the whisper numbers that are at the top end, you're going to see your stock fall back down. This is a company that has been in the eye of the storm when it comes to tariffs. We've seen what Renault's numbers were like, what Stellantis' numbers were like just yesterday. And when you've got that sort of tariff exposure, then the chips that are going into the future of EVs, for example, is going to be curtailed. Therefore, future demand is not living up to the hopes. NXP already was seeing revenue on the decline, but it was sharper than expected in the fiscal second quarter. And the forecast really is where the expectation is being a little bit underwhelming. So we're seeing revenue deplete quarter on quarter. And all of this at the moment is as we start to see also not just the auto sector be under the pressure, but also just automation of manufacturing, the thing that we keep talking about bringing to the United States. Well, globally, it's been impacted by tariffs too.
Really mixed bag when we look at how tech earnings have been coming out so far in tech impacted sectors. But I want to talk about Google, Alphabet. Yeah. You are looking at them on a 9-day winning streak, on track for their longest winning streak since December of 2010. Yeah. So a lot of excitement heading into those results tomorrow. How are investors kind of stacking up how they'll do?
I think they're looking at the valuation, Sonali, because actually compared to the S&P 500 or compared to the NASDAQ 100, the valuation of where Google trades versus its future earnings is much less than rivals. What has been the cloud for Google and Alphabet, the parent company, is of course antitrust. The worry that they won't be able to be garnering as much money from Apple in the future because, of course, the fact that you're going to automatically be putting maps on an Apple phone, for example. All of this just means that we're worrying about the monopoly of the future and the way in which that they're being impacted as well for the future generative AI. Many have questioned whether the business model even needs to be split in two and whether you sell off the various parts. The fact that very few analysts have said that, but the fact they've said it at all, has all been this overarching cloud among valuations. So I think people are thinking, okay, look, numbers could look relatively possible. We've got Bloomberg intelligence analysts saying, look, we like the strength of the advertising sector for them. We like the way the AI overviews has been benefiting them, and they've been intertwining generative AI into the search product. And thus far, you and I might have ChatGPT on our phone, but it hasn't stopped us using Google. And I think until that starts to bear out in the numbers, we like the fact that they're still owning that space, and indeed Waymo as well, doing nicely for the other bets revenue stream too.
Yeah, I believe that segment is expected to see about an 18% jump when it comes to revenue. Looking forward to actually being able to parse through those numbers tomorrow. Speaking of Waymo, speaking of reporting after the bell tomorrow, Tesla coming up and taking the stage as well. You take a look at the GM figures this morning, really taking a hit from tariffs. Tesla has really positioned itself as, you know, the most immune from some of the tariff impacts that are hitting the automakers.
It is, but then it's deeply exposed to what is a pullback in regulatory support for the future of, well, solar, of future of better batteries, the future of EVs. What's interesting for Tesla is in the next couple of quarters, maybe you'll see a pull forward of the EV credit that's going to be wiped out, $7,500. Well, that's only going to suit you until the end of September. So buy your Teslas now. So maybe we'll see a slight support to what has ultimately been a dire state for sales in the US, Europe, and beyond for Tesla. Remember, we got the delivery numbers for their fiscal second quarter. They were ugly. They were down 13%. But as you say, they do make the cars largely either over in China or in the United States. So from a tariff perspective, maybe they're not exposed, but I think more from a sentiment from the administration, a change on support from also getting credits. Remember, they get an awful lot of money because other car companies can't live up to what had been previously enforced environmental targets. And so they bought regulatory credits from Tesla. They're not going to be buying them anymore.
Caroline, we're looking forward to your coverage. Of course, the earnings season kicking off hot and heavy. Bloomberg Technologies, Caroline Hyde. Now back to General Motors. Earnings beat estimates, but the automaker says that U.S. tariffs added more than $1 billion in costs for the second quarter. Let's bring in Bloomberg's Detroit bureau chief, David Welch. What did you make of the numbers themselves, David, and the outlook that they had given?
They affirmed their outlook for the year, which was already based on the hit they were going to take from tariffs. Look, I think this quarter was one that really shows the full impact of tariffs on the auto business, because the mitigation efforts GM is taking, resourcing some parts from companies inside the U.S., cutting costs internally. They've moved some production already by slowing assembly lines in Mexico and Canada for pickup trucks and then speeding up the lines at a big plant in Indiana. But these are all things that kind of nip around the edges of it. There's really no way for GM to get back to pre-tariff profitability, and I think that's why the shares are down. And on the call with analysts, CFO Paul Jacobson made a couple mentions to the company's profitability if you backed out that tariff impact. So what he's saying is, hey, the business is still solid and strong, but in this new trade environment, we're just not as profitable as we used to be. And that's what investors are looking at. How does this company and other auto companies, how do they raise profitability when they've got this huge headwind, this huge tariff bill to wrestle with going forward?
Well, David, my understanding is that you take a look at pricing, and that's a lever that GM hasn't pulled to this point. You take a look at their average sticker cost, and it really hasn't risen at all. When you think about tariff mitigation efforts that GM could take in this environment, what about just raising the price of their cars?
Yeah, look, everyone's been saying that for the last, 9 months, ever since Trump started rattling the saber about tariffs. And, look, you can't view that in a vacuum. GM could go out and say they're going to raise the price of everything they make by $10,000 and consumers just won't buy them. And these are consumers who are already beset by very high interest rates and pretty close to record vehicle prices as it is. Some companies have sneaked in very small price increases, but consumers are kind of tapped out. That's why we're selling on a pace for 16 million vehicles, whereas a few years ago we used to be 17 million vehicles a year plus. Consumers just aren't biting on it. They'll keep their cars longer and repair them. They'll try to go to the used market. Anything to avoid what is now an average monthly payment of well over $700, with a record number of people paying over $1,000 a month. And when people are tapped out, the tariffs kind of go into your profitability because you can't pass the cost on.
David, we're so grateful for your time. That is David Welch of Bloomberg News. And of course, don't miss it. Later this hour, we're going to speak to General Motors Chief Financial Officer Paul Jacobson. We will talk to him about any potential for price increases, if you can get them, those tariff strategies. Let's see what else they've got going on. Some movers also on our radar. Coca-Cola sales beat estimates. Cane sugar is coming this fall. You still see them down. Speaking of expectations relative to reality, Katie.
Yeah, this is to appease President Trump. This will be U.S. cane sugar. I haven't really been following this controversy, but definitely caught some eyeballs this morning. Not really making a difference in the stock price, but how about Philip Morris? It actually raised its guidance on strong sales of Zyn. We know that has been very, very popular. Got a boost from the FDA recently as well, but the stock down about 6% right now, Sonali.
Yeah, organic sales trailed estimates, even as Zyn remains that trading floor favorite, Katie. I'm also watching CSX. You pointed this out this morning as well. Last night, it made a lot of headlines. That report that BNSF is exploring a takeover of a rival. Of course, CSX is considered to be potentially in that crossfire. Let's see how it goes. Railroad consolidation. I know we're going to talk about that more later in the hour.
Yeah, the sell side definitely catching that attention there. TD Cowen raising its price target and upgrading CSX, basically on the idea that it could be a consolidation target. We'll talk more about that, as Sonali said. But coming up, Treasury Secretary Scott Bessent calling for a review of the Fed's headquarters, but says that he sees no reason for Jerome Powell to step down right now. That conversation up next. This is Open Interest.
And now to high interest, to look at what's making headlines around the world. OpenAI and Oracle announcing a partnership to develop additional U.S. data center capacity to power AI workloads. OpenAI has not yet said where the sites will be located, but states including Texas, Michigan, Wisconsin, Wyoming are all under consideration. And Open Door Technologies is extending its gravity-defying rally from last week. Investors pile into the stock and found a sudden fandom among retail traders and social media platforms. Take a look, another 20% higher. Pre-market, analysts are comparing the moves to what we saw in the GameStop era in 2021, which you might remember very well. And paint maker Sherwin-Williams missing earnings estimates and cutting its profit forecast thanks to soft demand for paint products. The CEO expects softness to get worse in the second half of the year. Pretty interesting setup, Katie, as earnings season continues to forge on.
Absolutely. Watching companies try to navigate the geopolitical landscape and what trade policy is at this day is definitely something that we'll continue to watch. But let's head to D.C. right now, because the Federal Reserve is hosting a conference day in Washington, providing updates on key regulatory capital framework. Fed Chair, Jerome Powell kicked off that conference.
We need to ensure that all the different pieces of the capital framework work together effectively. Doing so will help maintain a safe, sound, and efficient banking system for the benefit of the people we serve.
And for more, we're joined now by Stuart Paul of Bloomberg Economics. And Stuart, let's pull back the cover. Everyone just wants to know about what's going on between the president, the administration, and Jerome Powell. You had Scott Bessent on the wire this morning saying that he doesn't see a case for the Fed chair to step down at this moment, but I mean, we know which way the wind is blowing when it comes to the whims of this administration.
That's right. The administration very clearly wants lower interest rate policy. The administration very clearly wants the Federal Reserve to cut interest rates by 200 to 300 basis points. That's what we heard from the Fed chairman. And they're using other functions of the Federal Reserve, including its banking authorities, including other sort of like supervision requirements that it's imposed on the banks that it supervises, and including the renovations to the Federal Reserve's headquarters as some sort of red herring or cover to muscle or apply political pressure to the Fed to lower interest rates. But that's an ever-evolving set of circumstances. As you said, just this morning, Scott Bessent was taking a step back and saying monetary policy, the monetary policy and interest rate setting function of the Federal Reserve should be sort of set aside in a jewel box. And I think that that's right. If you want to take shots at the Fed for spending too much on its renovations, fine, but that interest rate setting authority of the Fed should be set aside.
So speaking of the jewel box, Katie, you pointed it out this morning. I think it struck a lot of people to hear Mohamed El-Erian, of all people, say that if the Chair Powell's objective is to safeguard the Fed's operational autonomy, which he deems vital, he says, then he should resign. And I think it raises the question here, surprising to hear this from him. He says it's not the consensus view, but does this show that the pressure being put on the Fed chair is already impacting the market? It's already impacting what the independence of the Fed is perceived as by the market.
It is a little bit, and we saw last week when news reports hit the wire that the president was planning on firing Fed Chair Jerome Powell. Long-term bonds sold off pretty dramatically. When the president then pulled back during a meeting with, I guess, the Bahraini prime minister, that no, in fact, he was not planning on firing the Fed chairman, we saw prices rebound for those long-term bonds. Now, so clearly, Dr. El-Erian is correct that the market is questioning the extent to which the Fed can stand pat and stay politically independent of the administration. But as he goes on to say in that quote, the first best situation is not for the Fed chairman to resign. The first best situation is for rhetoric to sort of be toned down in the White House. And I think that we can see some of that. We are seeing some of that from Treasury Secretary Scott Bessent.
And it's interesting, it feels like this is really heating up as we really barrel into a Fed meeting next Wednesday. Jerome Powell, even on the best days, I feel like he doesn't look forward to the press conference, but next Wednesday, I feel like he especially won't be excited for some of the questions he's going to be taking.
No, he's undoubtedly going to be sent the question, how much are you taking political considerations into account when you're setting interest rate policy? I think that the only real question to ask him about political considerations is, do you feel more compelled to stand pat and hold interest rates steady in the face of political pressure? When he then says, no, we're actually just focused on serving the American people, you then have to go and the next question as a follow-up should be, well, the bond market just last week and into this week has been questioning your independence, has been questioning your resilience to that political pressure. What can you do to regain the bond market's confidence that you are in full control of monetary policy?
That's the big question. We'll see if he gets that one next Wednesday at about 2:30 p.m. Stuart Paul, Bloomberg Economics, great to speak with you. Let's take a look at these equity markets just about 10 minutes away from the opening bell. You can see, again, taking a bit of a breather when it comes to the S&P 500. I'm going to go ahead and call that unchanged, but we know we managed to close in the green at a record yesterday, so can't complain too much. Then you take a look at the NASDAQ 100. Down slightly, but pretty much unchanged. Same story, too, if you take a look at the small cap Sonali.
Can you believe that Matt Miller is not here to see 6,300?
I know. Somewhere, Matt Miller is celebrating.
Anyway, some more movers on our radar. A lot going on under the hood. Coal stocks today, they are climbing on potential production cuts at Chinese producers following government mandates to limit overproduction. Katie, have you been learning more about coal and copper?
Coal and copper? As I learned yesterday, smelting. It's a whole thing. You can produce the copper in the U.S. and you got to send it out. I look forward to continuing my knowledge there. But coming up, analysts saying that Serepta has zero value following the drug makers' fight with U.S. regulators. We're going to bring you the details on that skirmish next. This is Open Interest. Well, we're monitoring Serepta shares continuing to drop in the pre-market, falling 35% on Friday alone after its fight with the FDA developed. The FDA, Serepta rather, refusing to pull its lead therapy and then finally announcing a voluntary pause of the drug. Let's talk about this with Bloomberg Health reporter Bob Langreth. And Bob, you were telling us in the commercial break that controversy has been following Serepta for a while, but get us up to speed on what's currently happening with this company and the FDA.
Yeah, so Serepta's drugs have been controversial for a while over like the level of data backing the efficacy of the drugs and whether the drugs truly slow the disease or not, because the trials have either not been completed or in the case of this gene therapy produced kind of mixed results at best. But now the latest controversy is over the safety of the drug, and there have been 2 deaths in people on this gene therapy drug linked to liver failure. And then there's a third death that just emerged last week on a related gene therapy from Serepta, also from liver failure. And then that developed this huge fight, this unprecedented fight between the FDA and Serepta over whether Serepta should stop shipping completely stop shipping the drug while the FDA investigated the deaths and the safety. And Serepta on Friday initially, refused the FDA's request to stop its shipments. And then late last night, it reversed course and capitulated and agreed to stop shipping the drug, which is its main drug. It's its biggest drug, this gene therapy drug, until the FDA finishes its investigation. So now it's not shipping, its biggest product. The future, its future, it's just not clear what's going to happen to the company right now. And it has a big debt load. Some of it's due pretty soon. And everything's up in the air.
Yeah, well, when it comes to the future, you have H.C. Wainwright coming out and said that this company is worth 0. That is officially their price target. Bob Langreth, I know you're a busy man following this company. We appreciate your time. Now, less than 4 minutes until the opening bell. We're going to walk you through all the opening action up next with Doug Ciocca of Kavar Capital. That conversation up next. This is Open Interest. We are moments away from the official start of trading on this Tuesday morning. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. You take a look at the setup as we head towards that opening bell. You can see a market really looking for direction, maybe dealing with a little bit of buyer's fatigue. Of course, we know we have a whole bunch of risks staring us in the face, really getting into the heart of earnings season, just 8 days away from that Fed meeting next Wednesday. And for right now, it seems like traders are content to let the S&P 500 hover, and I stress hover, at these all-time highs. You can see that the bells are ringing over at the NASDAQ, down at the New York Stock Exchange as we officially get underway on this Tuesday. Hopefully there's a little bit more action underneath the surface here.
There sure is, and traders are discerning this morning on earnings season. You have Lockheed Martin that was already down on the year. They cut its forecast after reporting a $1.6 billion loss on its aeronautics and helicopter businesses due to special charges. The stock down almost 9% at the open after more than 5% this year, Katie.
And we're also keeping an eye on General Motors actually beating estimates, but the automaker said that U.S. tariffs added more than $1 billion in costs for the second quarter. We'll be speaking with the CFO in just over 10 minutes time. But I also want to talk a little bit about Kohl's here because shares are absolutely surging, up 85%. That move would be the biggest on record if that holds through the close. Still looking for a reason here. We will keep you updated. One potential, though, could be the fact that you have short interest clocking in at 48% of its float. So maybe a little bit of a short squeeze underway. We'll continue to monitor whatever is going on with Kohl's, but let's broaden out here because you have fund giants, including Invesco, Fidelity, and JP Morgan, really leaning into risky bets despite global trade tensions. Those firms are justifying that risk exposure with a Trump put, betting that President Trump's threats to disrupt the economic order will fall short of a complete collapse. That could suggest that sitting out of this market volatility is the riskiest position of all. Kavar Capital Partners CEO Doug Ciocca joins us now on that point. And Doug, it's interesting. At the same time that you have $7 trillion in money markets and growing, you also have the S&P 500 just going up and to the right. How are you making sense of the different cross currents at this point?
Yeah, thanks for having me on this morning. I think the market is in what we're calling kind of a greed with caution phase. I mean, there's certainly plenty of tailwinds, right? Earnings per share growth, it's early, right? But 83% of companies that are reporting right now are beating, so that's encouraging. So a very strong labor market, so that's fueling the consumer base of our economy that we rely on for propulsion. I mean, we do have modest improvement in like U.S. geopolitical standing, believe it or not, right? Despite some of the ongoing negative headlines. We've got currency weakness that helps multinational companies. And like I said, currency, consumer resiliency. And keep in mind, Katie, that still 48% of the Russell 3000 are trading 20% below their 52-week highs. So if you broaden out, there's still some opportunity in investing in stocks for sure.
What an optimistic point of view on this. I think that this is exactly where I was going to go next, because if you look at the S&P equal weight versus the S&P 500, there is a divergence, and you're actually seeing, and I'm stealing this from Kevin Gordon over at Schwab, another fresh 22-year low for that equal weight relative to the cap-weighted S&P 500. And it just shows you how much love there has been for the really big guys. I'm wondering how you feel about the catch-up trade. Who can be a part of it through the rest of the year when you still have tariffs weighing on some earnings?
Yeah, if you think about it, Sonali, right, you have four sectors that are really leading the U.S. market. And interestingly, I think everyone would be like, oh, technology. Well, technology's third behind industrials and utilities. You have two sectors of the S&P that are actually negative year to date, right? You've got consumer discretionary and healthcare. Healthcare down by almost 3.5% year to date, so underperforming by 1,000 basis points of the S&P. And certainly, right, investors over-extrapolated probably the enduring positive impacts of COVID. I think they are now over-extrapolating the negative impacts of RFK's policies. And undeniably, right, mean reversion is very strong, but people probably overestimate how quickly it's going to happen on both the way up and the way down. So I think if you're just taking opportunities, the dollar cost average and the names that have been underperforming, but that have really strong balance sheets, great total addressable markets, and really strong sightlines on future cash flow with a multinational bent, there's still a lot of places to put money to work in the equity market. And that doesn't even mention the fixed income universe, which we think is still very attractive.
Well, just to your point on healthcare, don't forget we have the looming threat of pharma tariffs as well that this market is trying to make sense of. So we'll continue to watch that one. Healthcare, your worst performer year to date on the sector level. But let's talk a little bit about fixed income. I actually had a great conversation with the deputy CIO of DoubleLine Capital yesterday, Jeffrey Sherman, who said that he's positioning here for lower rates, that there could be a shadow Fed chair dynamic going on. We know that probably against Jerome Powell's wishes, the conversation around the Fed has become very, very political. How do you approach that, rather, from an investment standpoint?
Yeah, so if you think about it, right, what's most important about the bond market, right, is strong balance sheets. And corporations as well as municipalities have very strong balance sheets. They took opportunities, unlike the federal government, to refinance their debt when rates were at historic low levels. So you have really strong balance sheets. You also have tight spreads. So in our opinion, it doesn't make any sense to try to deviate from high quality because just not enough yield pickup to do so. You can put in place almost like a barbell strategy because the middle of the curve, even though we've seen steepening, the middle of the curve is still offering some opportunities. If you can lock in 15, 20-year maturities at 2.5% to 3.5% of positive real yields, and then sort of spend a little bit more time at the front of the curve so you can be a little bit more flexible in reacting to Fed policy, we think that makes a lot of sense. But when you think about bond investing right now, be prepared for the perverse, right? The Fed cut rates 3 times, 100 basis points last year, and what happened? The yield curve steepened, came out of an extended inverted state.
Yeah.
That was way counter to what people's expectations have been.
I want to double down just on that point, because even if you get those rate cuts, there is a lot of doubt in this market that you can see it bringing down the long end of the curve. It was certainly what the Treasury Secretary would want. However, you have the market consistently betting on steepeners, particularly when the president has put so much pressure on the Federal Reserve. Deutsche Bank is looking at 30-year, so they're looking at the 5 to 30-year spread here. How much risk is there at the long end, and how much risk does that provide to the equity market as well if long end rates stay high?
Yeah, it becomes a headwind, but it comes back, Sonali, to supply and demand, right? If Bessent and the Treasury Department are talking about refinancing debt at lower levels, therefore the bludgeoning in public of Powell's unwillingness right now to cut considerably. If that happens and they buy more debt at the short end, you're going to see prices go up and yields down. They're neglecting the longer end, right? So you see prices go down and yields go up. So we do think there will continue to be some spread widening, but they're also actuarially, when you get to, let's say, 5.5% 30-year, God forbid it gets to 6%, which is actually joking as relates to God forbid, because that could be a great opportunity. You have a lot of large institutions, pension, actuarial, hedge funds that will lock in those spreads, not to mention some of the carry trade capability that may arise. So we think there'll be enough demand when you get to that significant barrier, 5 to 6%. So that would probably stabilize that area, but supply and demand would indicate the curve's going to steepen if the Fed cuts.
All right, we'll have to check back in with you on that once we finally start to get some of those Fed cuts. Doug, great to see you. That is Doug Ciocca of Kavar Capital Partners. Meanwhile, let's get a check on the stock market right now. I am so excited to talk about this move screen because take a look at that breadth. It's actually really good right now. You have nearly 400 companies in the green posting gains this morning, just 100 or so in the red. But you have the index pretty much unchanged, maybe a touch higher because take a look at the downside. Up at the top, NVIDIA down 1.4%. That is your biggest points contributor to the downside right now. That is weighing down this index, really keeping the S&P 500 constrained, even though you have all these names fighting to go green. It's a similar look at the sector level as well. Positive breath, really strong signal there, but still, when you take a look at what is losing today, it's the important names. It's tech down about 0.4%. Consumer staples also taking a hit. We were just talking about healthcare with Doug Ciocca. You can see that healthcare, it's the worst performer year to date, but it's the best performer on this day, up 1.3%. That might seem unintuitive given our conversation around Serepta, what's going on with that health stock, but Serepta isn't in the S&P 500, and as such, you can see healthcare is your winner, at least for this moment, Sonali.
And coming up next, we're going to talk about another sector, autos. GM shares are falling, actually the most since April intraday, as President Trump's tariffs hit the company's earnings. We're going to be joined by General Motors Chief Financial Officer Paul Jacobson joining us next. This is Bloomberg Open Interest.
Welcome back to Open Interest. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Lululemon is getting downgraded over at JP Morgan. The analyst cites a more cautious and discerning consumer and sees growth constraints in the Americas region. Shares up very slightly this morning. Next up, we have Shopify getting cut over at Loop Capital on valuation concerns. Now, the analyst says that they would wait for a more attractive entry point. Maybe they're getting it today. Shares down 2.3%. And finally, TD Cowen is adding Norwegian Cruise Lines to its top picks ahead of its earnings next week. The analyst is also initiating coverage on Carnival and Royal Caribbean with buy ratings, saying that cruise lines in general are underappreciated. Now, one stock that we're keeping a close eye on this morning is GM. Shares are lower after the company said it will take a $1.1 billion hit to profit from President Trump's tariffs. Let's bring in General Motors Chief Financial Officer Paul Jacobson for more. Paul, it's great to have you with us. I want to talk about potential levers that you can pull here, because my understanding is that you really haven't raised prices to this point to offset some of those costs. I know that you're taking other measures, but is it possible that you could raise the sticker price on some of your vehicles to make up some of that hole?
Well, good morning, and thanks for having me today. It's a beautiful day here in Michigan, and we're celebrating another good quarter. And I think obviously tariffs have had some pressures. We've adjusted to them, but as we just said on our earnings call, we're 90 days into this, and our plans are still very consistent with what we said at the beginning, and we're going to continue to execute on that. We've got a strategy here that is both short-term and long-term. In the shorter term, we've talked about our ability to offset 30% of the tariff impact. That's through some cost austerity as well as some manufacturing changes and pricing. But we think that as we maintain our consistent pricing strategy where, we look at the demand for our vehicles and where that sits and our disciplined inventory approach, that we can continue to absorb that and reflect that in our traditional and sort of consistent pricing actions rather than going out and announcing big tariff-related increases, because we don't think that's necessarily good for the consumer as well. So pricing is a part of it, but nothing out of the ordinary or extraordinary from what our current strategy has been.
How much flexibility, Paul, do you have to make adjustments to supply chains here to meet the evolving auto tariffs and the parts that tariffs might hit in parts of the supply chain?
Well, there have been things that we've already been working on. So really, kind of since COVID, we've been looking at creating more resiliency in the supply chain, and we've onshored a lot of things, as we mentioned in our last call. Only about 3% of our direct purchases come from China through the supply chain. So that's helped us a little bit in terms of being proactive on that. Obviously, we'll do some resetting in partnership with our supply chain partners, but it really starts with our manufacturing footprint. Earlier in the quarter, we announced $4 billion of investments over the next couple of years to increase production in the United States. And when we're done with that, which will start in about 18 months, we'll be producing more than 2 million vehicles here in the U.S. So comfortably putting us in a position where we produce more vehicles here in the country than anybody else. So we're working on those and also partnering with the supply chain across the board. So while we have a pretty sizable tariff impact this quarter, as we've talked about, it's not a surprise against what we told the street at the beginning of it, and our plans are executing well according to our playbook.
Let's talk about how those plans play out over the course of 2025, because GM has said that you can offset 1/3 of that $4 billion to $5 billion in tariff exposure later this year as more of your mitigation efforts really start to take hold. Can you give us a timeline there? When might we see some of those efforts actually start to bear fruit in terms of offsetting some of these costs that you're dealing with?
We'll really begin to see that in the third quarter and the fourth quarter, as we've told investors. Some of it is pricing, and our pricing was up in the first quarter. It was about flat here in the second quarter, but we've expected pricing to be up about 0.5% to 1% for the full year in 2025. So as model year 26 comes out, we start to see some of the benefit of that going forward. There's some cost initiatives which will be coming in the second half of the year. The team's done a good job of making sure that we're maximizing efficiency where we can, so we don't have to put all the burden on our customers to absorb all that. So I think we're in good shape. The second half should be better and should be more offsets than what we saw in the second quarter, as we're just adjusting to it. But that remains consistent with that 30% assumption that we had going into the year.
Paul, and this isn't specific to GM, but I do wonder how you can have confidence to say, the third quarter is when we might start to see these efforts bear fruit, given that it feels like the tariff landscape in particularly dramatic periods can change day to day. And from where you're sitting as the CFO of General Motors, is your opinion that the current tariff structure, the current stance of this administration, does this make U.S. manufacturers, U.S. automakers actually be more competitive at the end of the day?
Well, I think over the long term, certainly we do believe that it can be a more rational and more stable industry for us across the board, and we're going to work through that. We've already announced significant plans to increase production here in the U.S. It started with the decision to increase the line rate and our production rate in Fort Wayne, where we'll produce another 50,000 trucks and SUVs on our trucks on that line going forward, and that'll hit us this year. So that's already taken effect. The changes that we announced earlier this quarter, we'll start to see those in about 18 months across the board. So, I think it clearly is having the intended result, and one that I think will be net good for us going forward over the long run. We are optimistic about bilateral trade deals, and as they work through, in particular with Canada and Mexico, and also Korea with our footprint there. But we feel comfort in the fact that the auto industry is very important to us as well as it is to Korea. So we believe that they'll be able to work out a deal, and ultimately that'll be good for both countries.
What can you tell us about any future capital allocation? Is GM planning to do any share buybacks, especially in light of some of the cost reduction efforts you're taking in the second part of the year?
So capital allocation is one thing that I think we're really proud of as a team, and what we've been able to deploy consistently. First, we invest in the business. We'll be investing $10 to $12 billion over the next couple of years. That will allow us to both improve and continue our great vehicle portfolio, but also these footprint changes that I mentioned earlier. But even with that, we're producing sizable free cash flow, and we're able to make sure that we protect the balance sheet as well as as return capital to our shareholders, and we've established a pretty good track record for that. Earlier this morning, we announced that we've resumed share repurchases in the month of July. As of June 30th, we had $4.3 billion remaining under our authorization and strong free cash flow projected. So I think it's something that the shareholders can benefit from as well as we drive this efficiency into the business to ultimately help mitigate some of this tariff exposure. So overall, I feel good about where we are, and we're working hard for the shareholders.
Paul Jacobson, Chief Financial Officer of General Motors. We thank you so much for joining us this morning. All eyes on that auto industry. And coming up next, all eyes on railroads as well. CXX, Norfolk Southern, BNSF is reportedly eyeing a deal, and investors are sussing out whether it's one of the two. More on railroad M&A next. This is Bloomberg Open Interest.
BNSF, it's the railroad giant owned by Warren Buffett's Berkshire Hathaway, reportedly working with Goldman Sachs to explore a takeover of the rival. Let's get more details now from Bloomberg's U.S. Deals Managing Editor, Leanna Baker. So that is the rumor out there, right? And that's what the street seems to want to believe. Warren Buffett maybe not cooperating with that narrative.
Right. So we couldn't independently verify the info, and it looks like he threw a little cold water on the report. Warren Buffett doesn't love working with bankers, paying that extra fee. However, it makes sense right now for all the different railroads to find a dance partner and probably use a banker to do so. So it's not crazy that all these railroads would have an advisor, since there was a report last week that Union Pacific, the largest U.S. railroad company, was in early talks to buy Norfolk Southern, which would create a transcontinental railroad and set off potentially a wave of consolidation in the space.
Yeah, can you drill down a little more here on how the dance card is going to play out here and how there are not that many of them, right? So do they all have to consolidate at some point?
It's a great question. So there's about 4 of these Class 1 railroads, as we call them, and there could be, different combinations. But from what analysts are saying, Union Pacific and BNSF, the bigger players, would have to be the buyers, let's say. They're also the West Coast players, and then the East Coast players, Norfolk and CSX. Those would be the ones they'd have to combine with. But we're not sure at this point, which ones will play out. But we have reported that Union Pacific is in early talks with Norfolk Southern, so that's definitely one to watch.
What are you hearing about why this specific moment? And is it just because we got a deal last week, now we're looking around the rest of the space, or has this been percolating for a while?
There's a few things. So the Union Pacific CEO, Jim Vena, since he came out of retirement, he's been sort of banging the drum that there has to be consolidation in the space. The regulator that governs railroads, the economic regulator, the Surface Transport Board, Trump installed a new chairman. So it's a Republican chairman. And if these companies believe the Transport Board will approve mergers, now's the time to pounce with this administration.
Absolutely. This is the space, one of the spaces to keep an eye on. Great reporting. Looking forward to more of it. That is Leanna Baker of Bloomberg News. Now, coming up in the next hour, it is packed. We'll be speaking to the U.S. CIO of Mercer on tariffs, testing earnings. Then we'll talk about regional banking with Fifth Third CEO Tim Space. Looking forward to that conversation. And also, venture capitalist Alan Patricof joins to discuss investing in longevity. Don't go anywhere. This is Open Interest on Bloomberg.
And we are 30 minutes into the trading day. We're looking at an S&P 500 coming off its record highs, below 6,300 now, down 0.3%. So too is the NASDAQ 100. Almost every major Mag 7 name in the red. Katie, what an interesting trade heading into earnings season. I'm Sonali Basak. Welcome back to Open Interest.
And I'm Katie Greifeld. And you're right, we're seeing a sell-off with some conviction behind it. It's just the big tech names, but trading volume about 18% higher than its 20-day average.
And we'll talk about what's driving the trade and also earnings season. It's picking up. Reports from Tesla, Alphabet, both on the horizon.
You also have Treasury Secretary Scott Bessent offering support for Jerome Powell, saying that he sees no reason for the Fed chair to step down right now. We'll see if that changes.
And from M&A buzz to crypto mania, we're going to get the Main Street view on banking with Fifth Third CEO Tim Spence. And we're going to begin with stocks stalling ahead of a busy week of earnings. The market is facing a key test with results from Alphabet and Tesla due tomorrow. Clearly a little nervousness as we stand here near the top. Joining us at the desk, Olaolu Aganga, U.S. Chief Investment Officer at Mercer. And you work with so many clients across the United States. And when you're looking at the valuations in the U.S. equity market in particular, how nervous are clients to be investing at these levels?
You know, this has been a V-shaped recovery, if I can say one. I mean, if you think of where we started at the start of the year, we're roughly back at those levels. So valuations were elevated to begin with. We had the sell-off. It was a V-shaped recovery. Even during the depths of the sell-off, we really weren't at attractive valuations. It was getting towards fair. So now we're just kind of getting back to it. Now we're in the middle of earnings season, and we're getting to see what the impact of tariffs could potentially be.
Let's talk about earnings season because I'm stuck on this Bloomberg intelligence stat from yesterday that you take a look at the companies that are missing. The market is punishing those companies by the most in about 3 years. So it feels like the sentiment bar is actually still really high right now.
Sentiment bar is really high. Some of the autos that have missed have really felt the impact of tariffs. But back to valuations. Valuations are elevated. So right now, earnings expectations across the street aren't as high as we would have thought they would be. You have to do a lot to grow into where things are right now. And they're coming in either fine, in line, some little misses, other than the tariff impacts that are impacting some of the other companies in a meaningful way.
It's an awkward year because you have the tariffs that are still moving around.
Yep.
You have the earnings that are coming in. And to Katie's point, the misses are being pretty brutally met by the street. But people are already looking into 2023 and these full year guidances and a mixed bag on where people are guiding to.
Yeah.
So how do you feel about any risks heading into next year at this point, given that this year has been so uncertain?
So we have advocated at Mercer diversified portfolios, even when the peak of valuations, and we're still there in the U.S., U.S. dominance was showing. We'd invested in international equity markets just the same. So now, where equity markets in the U.S. have rebounded, we're still seeing a pretty decent spread between international markets and U.S. So the diversified portfolios are there. We're advocating for them. We've done things like increase our currency hedges for those that are invested internationally, just because of dollar swings. But short of that, from long sustainable portfolios, diversification is what we've been advocating.
We're hearing a lot of that these days.
Yeah, absolutely. And I want to take this conversation from the public markets into the private markets because I know that's a focus for you over at Mercer. You take a look at some of the private asset managers, as we've been talking about on this show. Their public equities have been getting punished this year. So what is going on in the world of private credit, that murky place that we can't actually just take a look and see how it's performing on our Bloomberg?
Now, private credit is, as we all know, born out of the financial crisis in 2008 and has really skyrocketed. So a lot of the activity that we are seeing is activity that was done by banks. Now the market is a few $1 trillion in size. We've got direct lending, venture-backed financing, asset-based lending, and opportunistic. It really is an opportunity to be able to earn higher returns. A lot of the market is direct lending, so floating rate, so yields where they are is pretty attractive. And the debt covenants are still incredibly strong. We've seen low defaults in that space. You also have income generation that can come from there. So it checks a lot of boxes, frankly.
I want to talk about another alternative, let's call it that, crypto. Because you look at public markets and you're seeing crypto playing a bigger and bigger role, S&P 500 inclusions we're talking about, as well as more listings. And do you recommend that your clients accept it as a reality at this point, that crypto is going to be a part of your portfolio just like any other stock or bond would be?
Well, the entire cryptocurrency market is, what, 21,000. There are thousands and thousands of cryptocurrencies. So the standard of care, the due diligence that needs to be involved is extensive. For institutional portfolios, for retirement portfolios, that standard of care is even higher. Now, the Genius Act was passed last week. That is very specific to payment stablecoins, so a subset of it. It's the beginning of legislation that we're seeing in the space, and a welcome one, because it does talk about some of the backings, the consumer protections that exist, the regulatory bodies. If more of that comes into bear across the industry, then it could start being attractive for inclusion. But right now, the volatility and some of the protections just aren't as robust as we would like it to see for institutional client portfolios.
And we should say that the House also released a draft of the crypto market structure bill. So the Genius Act passing, and now that market structure bill, clarity is what they call it, coming into play.
Absolutely. Legislation and crypto regulation really entering the spotlight here. Before we let you go, I am curious. I mean, when you take a look at this market in totality, when you take a look at private markets, public markets, crypto assets as well, where's the most opportunity at this point? Is there anywhere where you can really go on the offense versus maybe just trying to avoid some of the potholes?
So if you think of our client base right now, a lot of focus is on income and cash generating assets. We haven't seen the distributions that we would have expected from private equity. We have seen a lot of legislation that is causing clients to really think of their cash flow if they're operating entities. So cash flow, yield generation, those are more attractive asset classes, which you find in private credit, you find in real estate, and a number of other areas.
All right, that is the name of the game. Great to get some time with you. Our big thanks to Olaolu Aganga. That is the U.S. CIO of Mercer. Let's get back to what's going on in this equity market, because, boy, it's looking dramatic under the hood. Let's take a check now with Bloomberg's cross-asset reporter, Isabel Lee. And speaking of crypto, we're starting here with Circle.
So Circle shares fell, and that's after the stablecoin issuer was downgraded at Compass Point Research. So to Sonali's point and your point earlier, the reason is because the U.S. stablecoin bill has passed. So we have analyst Ed Engel saying that, they will have more rivals now. They cut the price target from $205 to $130. Now it's hovering at around $197. And it's true because we have American Express this week saying they're exploring stablecoins, whether through its own offering or through a partnership. And sources have been telling us that a lot of institutions have been asking them to ask how are they going to position themselves with stablecoins and around that. And we have one source saying there's a sense of urgency here. So we really see a lot of rivals from there. The analyst said that long-term EBITDA margin and market share expectations may have to be recalibrated. So you see the shares there down by almost 8%.
Let's check in on GM as well. We've been talking about it all morning. They're looking at that tariff hit. Shares are being driven down quite meaningfully.
Meaningfully, it's down by almost 7%. So GM's second quarter profit fell, and that's because the tariff chopped basically $1.1 billion from its adjusted earnings. So even if the automaker earned $2.53 in the second quarter, which is above consensus, year over year, it still fell. GM's profits suffered from higher warranty costs and just a buildup in inventory. And again, this is emblematic of just really how this current environment is punishing like global integrated supply chains and just cross-border sales, and GM is one of the biggest sufferers.
Absolutely. You can see GM shares now down 7%, just a wipeout underway. Not quite a wipeout when it comes to those underappreciated cruise lines, though.
I've never been on a cruise. I'm always excited to report cruise lines. So we have Norwegian Cruise Lines rising because it received a bullish initiation from TD Cowen. And to be sure, they also initiated rivals like Carnival and Royal Caribbean, also with a buy rating. So the analyst there, Kevin Kopelman, said that cruise lines have a strong value proposition because across price points, they have a good offering. So get this, they said average cost per day of a cruise ticket is around $160 in 2024, and that includes voyage, unlimited food, and numerous amenities, versus an average hotel room in the U.S., which is only $120. This probably doesn't include New York, because here it's kind of crazy when you book hotel rooms. But that's his claim, that they have a strong value proposition and it's underappreciated. So he's bullish on that.
Isabel, thank you so much for joining us this morning. That is Bloomberg News' Isabel Lee. Let's take a look at Kohl's this morning, because those retail traders have been driving up stocks pretty meaningfully. This is a $1.5 billion market cap stock right now. And in just today alone, they've added more than $300 million in market capitalization.
Yeah.
So an enormous amount of value just added today on the heels of what has largely been seen right now as mentions by retail traders on social media.
Yeah, could be a short squeeze. We know that short interest is a pretty high percentage of the float. Kohl shares higher by 105% at one point today. It's been halted for volatility a few times. We should also mention that Open Door shares were halted as well, up 15% at one point. So definitely there's some meme momentum entering this market in a big way. We're going to try to unpack that in a few minutes. But coming up next, M&A deals.
M&A deals are back. Banks are missing out on the gold rush in some ways. We're going to explain why in the Wall Street Beat. Stick with us. This is Bloomberg Open Interest.
It's time now for high interest. Look at what's making headlines around the world. And Treasury Secretary Scott Bessent is offering support for Fed Chair Jerome Powell, saying he sees no reason for him to step down now. Bessent is also calling for a review of the Fed's non-monetary activities, including that costly renovation project. Next up, Oscar Health is slashing its guidance as it reports preliminary results below Wall Street estimates. Now, this is just the latest health insurer to be rocked by troubles in Affordable Care Act marketplaces. The company said that data is showing that there are higher risks in ACA markets than it previously expected. And we have BlackRock telling its staff traveling to China for business trips to use temporary loaner phones and to not bring company laptops. This move underscores growing jitters around business travel to China, with U.S.-China geopolitical tensions really weighing on those global financial firms, Sonali.
And it's time now, Katie, for the Wall Street Beat. This is my favorite dynamic to watch on Wall Street because billion-dollar M&A deals are back. And that usually means that leveraged finance desks across Wall Street are raking in a fortune, drumming up business and debt deals. And this time around, private equity has actually been cutting them out of the most desirable deals. We're going to break it down with Bloomberg's Rashmi Basu. And really interesting to me because this comes at the same time when banks have been creating all of these capital solutions businesses to court private equity firms to make sure they can keep borrowing freely. Why are private equity firms now cutting out the banks?
Well, what we're seeing is these portability structures that are being embedded in these documents, which basically means that if you're a company that has a $1 billion loan, when you sell it to another private equity owner, that $1 billion loan transfers to the new owner.
Is there a preference here for them to be working with their private credit rivals because those private credit rivals often have private equity businesses of their own?
Well, what we're seeing this portability language in the broadly syndicated loan market right now. So that's where it's really making its headway.
And how does it work?
So basically, if let's say I'm a sponsor and I want to sell my company to sponsor B, and I'm basically transferring that capital structure to the new owner. And that means the lenders are then going to be participants to that loan to the new sponsor.
So how are the banks reacting to this? I can't imagine that they love it.
No, they don't love it because there's a lot of money to be made in buyout financing. So, a deal on average is about 2 to 3%, which would equate to $15 million on a $500 million deal. So they're kind of losing that money out.
So what does this mean about where we are in the cycle right now? Because something I think that's really interesting is you have a private credit market. We talked about this before, I think, Katie, that the private credit market, the direct lending market, is larger than that syndicated loan market these days, right?
Right.
And by many measures. Does this signal any froth of what's going on with these new waves of deals?
Well, I mean, yesterday we did see one of the second busiest days in terms of repricings. We saw like $62 billion in the leveraged loan market. So clearly the syndicated markets are still very important.
So what does this mean in terms of the types of deals that we're seeing? Because clearly we have not seen private equity come back in mass yet. And so the deals that are coming back, what's happening?
Well, we're seeing, again, as I said, a lot of repricings. We're not seeing a ton of LBO activity, but what we are seeing is, something you'd mentioned, we're seeing a lot of liability management exercises. And the market where we're seeing just a lot of private equity guys who are unable to sell their companies, they're now looking to take a discount through like distressed exchanges.
Tough times out there. Bloomberg credit reporter Rashmi Basu, we were looking for that private equity flood to come back. And in the meantime, we're looking at somebody that went from banking to the private markets, private credit in particular. That's Harvey Schwartz. His unconventional path took him from a troubled kid to a contender for the top spot at Goldman. And now, as the CEO of Carlyle Group, he's taking the firm through a major shift in finance and revealing forces behind today's highest asset class, which is private credit.
Where have you brought me?
Welcome to Morristown.
When was the last time you were back here?
Oh, I don't know, a very long time. I think maybe I came once since 1982.
You're giving me nightmares already.
Oh, there's no nightmares to have.
I was not cool in high school.
We kind of did some yearbook searching for you to see what
I was the most unsuccessful wrestler ever.
Did you do any clubs or anything?
No. I was a tragically bad high school student.
Schwartz had a tough childhood. His mother was bipolar, and his father was diagnosed with schizophrenia. They both had multiple suicide attempts. Your parents had a really large impact on you. I've only really heard you talk about your experience growing up recently.
Yeah, so I didn't talk about it for a long time because at a different time, there's a real horrible stigma around mental illness that exists today, which is tragic. But most people won't talk about mental illness. It's too uncomfortable. It's not accepted in society. Back then, there was no acceptability. I mean, the rule in a family was you could not talk about the family. And then over time, really over the past 10 years, I realized that if I talked about it in open forums, it seemed to somehow be comforting to people that there was even a willingness to have a discussion about it.
The way you describe it now, you say, my mother was diagnosed as what is now known bipolar. Was it diagnosed then? And you were so young.
Well...
Did you know what was going on?
No, it was just how my sister and I lived. And it was really sort of event to event. So hospitalization to hospitalization. I celebrated, I don't know, my 11th birthday. I celebrated many birthdays in hospitals.
His mother passed away from cancer when he was 14 years old, leaving him in the care of his father.
My father in particular got really consumed by his illness. And unfortunately, he developed a delusion, which was he thought everyone could read his mind. So he wouldn't communicate. So you and I have probably talked more than my father and I ever did in my entire life. So he wouldn't communicate. I sort of did my own thing. I became a bit of a feral kid.
You can hear more about Harvey Schwartz's unlikely story in the season finale of Bullish tonight at 6 p.m. New York time on Bloomberg Television or streaming at 8 p.m. on Bloomberg Originals. And something to note, really interesting, private equity stocks year to date. I want to point this out, Katie, because you were talking about it. You do see a lot of weakness in the likes of Apollo and Blackstone. They're both down on the year. Apollo down closer to 10%. Carlyle has been lagging until Schwartz came along. This year it's actually up quite meaningfully, up 18%. So mixed view on these firms here.
Yeah, you can see really starting to break apart in May. That's when that outperformance really started. So Carlyle ascendant relative to its peers this year.
And Blackstone reporting later this week. We'll talk to John Gray. We'll get deeper under the hood. Stick with us. This is Bloomberg Open Interest. We are now checking in on Kohl's because there has been some strange market moves today, to say the least, Katie. You're still seeing the stock up almost 30%. It's roughly the biggest gain since January of 2022, but earlier today it did have the biggest gain on record and has added almost $350 million to its market cap. We're going to get some more details now from Bloomberg specialty retail reporter Lily Meyer. And there's a lot of questions about how much retail interest is being drawn to the stock, about whether there's a short squeeze. The short interest was pretty meaningful, bigger than that even of GameStop. Is there anything fundamental about this company that would drive this kind of a move?
Yeah, I mean, a lot has happened for Kohl's this year. Its CEO was fired after the board determined that he had directed millions of dollars to business, to someone he had an undisclosed personal relationship with. The company's in a turnaround. It's really struggled to bring in customers. Sales has declined for more than 3 years. So it's been a rough year so far for Kohl's.
Absolutely. Amazing that was just this year that scandal, if you want to call it that, happened. And you have the difficult task of trying to talk about fundamentals in what appears to really be a meme moment. But give us the lay of the land. There were some bankruptcy rumors circulating on social media, for example, this morning. Is there any validity to that claim? Should this company be on that sort of watch list?
Yeah, I mean, I haven't heard anything to give validity to those claims, but I think the company has struggled with sales, as a lot of retailers have recently. But sales have been down for more than 3 years, and it's really trying to reinvent itself and stay relevant to its customers.
So what are the catalysts we should be looking at when it comes to Kohl's?
I think some of the catalysts would be if it's really able to bring customers back in. So some of its goals have been to refocus on fundamental areas. It's focusing on areas like fine jewelry. It's started to have partnerships with Sephora and Babies R Us. So I think focusing on seeing whether those have started to work and bringing customers will be really interesting.
Yeah, we're still over a month away from this company's earnings report, so a lot of questions that we need to wait for answers for. Lily, really appreciate you stopping by. That is Bloomberg's Lily Myers talking about Kohl's, which has just been going crazy this morning. As Sonali said, was higher by as much as 100% earlier today, but has since pared some of that gain and has been halted for volatility a few different times.
You know, it's not alone. I shot a note off to Citadel Securities while we were talking here to see, I'm like, give me the data here. Give me how strange it is in the meme stock market. Open Door has also been soaring year to date, but in the last couple of days, a little less today. Coming up, we're going to just talk about normal way course of business. We're going to bring in Fifth Third Bank CEO as we watch the regional banks. This is Bloomberg.
We need to ensure that all the different pieces of the capital framework work together effectively. Doing so will help maintain a safe, sound, and efficient banking system for the benefit of the people we serve.
That was Chair Jerome Powell speaking at the Federal Reserve earlier this morning because it's hosting a conference today to discuss the future of the regulatory framework for the banking industry. And joining us, Bloomberg's banking regulation reporter, Katanga Johnson. At the conference, he joins us now. A lot is changing. You know, one thing that's kind of stunning me a little bit here is that the rules are already set to be less strict than they were originally planned. The banks are clearly wanting much less tightrope here to be walking over. They want to have a full slate to be gliding through. How much more can things be relaxed from how much they've already been planned to be?
That's really an interesting question. That's the focus of the conference today. Regulators are hearing from a range of banks and academics and advocates who say that certainly new rules shouldn't be more onerous, they shouldn't be more strict, but regulators are cautioning, and we heard it in Powell's speech this morning, that the amount of capital in the system right now is actually about right, he said, and it's a matter of understanding, okay, if changes to, say, the main risk-based capital plan, the Basel III Endgame, and to stress testing do occur as we expect, what do those changes look like? They certainly shouldn't be more onerous than today, but hearing that Powell say that capital is about right now makes me think, and for everyone here, they might be trying to sort of walk that tightrope about exactly how to make those changes.
And we already heard from Jerome Powell today. Tell us what else is on the schedule. For example, I see an interesting conversation coming up at 1 p.m. The Vice Chair for Supervision, Michelle Bowman, talking with the CEO of OpenAI.
Yeah, this conference is really Bowman's brainchild for her. She wants to hear from a range of voices, but the key voice that everyone's listening to today will be that of Sam Altman. Altman will bring a perspective that organizers say is a bit balanced and nuanced. You of course, expect advocates on one side and bankers on another side to argue about the right balance of capital, what the requirements should be. But Bowman's hoping that Altman would really speak to broadly how, by having the right balance with capital and other requirements for lenders, what that means for the economy, what that means for novel and new sectors, including, of course, artificial intelligence. And the hope is that it'll be a breath of fresh air from the debate about what the right requirements are, and more on what, if banks get it right, if regulators get it right, how society, how Americans really benefit.
Big taste of what we're going to get in the Bowman supervision era. Very interesting day. Bloomberg's Katanga Johnson reporting from the Fed. We thank you so very much. And for more on the banking regulatory landscape, we are joined by Tim Spence. He is the chairman and CEO of Fifth Third Bank. When you look at the Fed's policy right now, the big question first and foremost, is how much should they cut? Should they cut more than once this year? Should the president get what he wants? And even more than that, how do you feel about where rates stand today and whether there is indeed pressure on the economy given where rates are?
That's a lot of questions at once, Sonali, and a lot of very good ones. If I could, before I get there, I want to put a point on one comment that Katanga made that I think is really important, which is the right way to think about the capital framework for banks is the impact that it has on the real economy in the U.S. and that it has on Main Street people in particular, because the banks are a derivative of the real economy, and we play a really important role in money creation and the supply of credit that then supports investment in new job creation and home ownership and a whole variety of other things. And if you look at the capital impact of Dodd-Frank regulation forward, and you just look at the loan-to-deposit ratio for all regulated banks in the U.S. over the course of the past 15 years, it's declined from like 92% to somewhere in the high 67, 68% range. That's $4 trillion of credit that was not created to support homeownership, the proliferation of capital equipment to support domestic manufacturing and otherwise. So I'm quite hopeful that one of the things that's going to come out of this look at the Basel rules, that's going to come out of the relook at the stress tests and otherwise, is going to be the opportunity for banks to support the real economy, to support people on Main Street a little bit better. Now, as it relates to interest rates, from my point of view, the Fed's always been focused on the right things. It's important that we promote full employment. It's important that we keep prices under control. And at least based on the way that the numbers are shaping up right now, I think inflation's been a little bit better than anybody expected. Unemployment has been, much better, I think, than everybody expected. There were a lot of concerns coming from the academics about the impact of higher interest rates on unemployment. But the labor supply has been tight, and the byproduct of that is, my view, and maybe we see a rate cut, maybe we see two, but we're unlikely to see a lot more than that this year. And that's certainly what we're telling our clients.
So there's a trade underway on Wall Street called the Powell hedge, a concern about the threats to the independence of the Fed. And part of that means from a lot of investors betting on lower interest rates on the short end, but a steepening, so higher interest rates on the long end. What's the implication of this, Tim? Do you see that the tit for tat is having a real world Main Street effect when you think about the future of the Federal Reserve and the pressure that the president is putting on it?
I mean, I think you hit one of the critical points there. I point out to folks all the time that we're not really a Wall Street bank. We're a Walnut Street bank. Walnut Street literally runs, perpendicular to our building, right behind me. And the right way to think about the questions around interest rates is the impact that it has on people and on Main Street businesses. So while the government is funding itself on the front end of the curve right now, most of the things that people care about, whether it's housing, owning a car, financing education, actually gets priced off of the belly or the long end of the curve. And the long end of the curve likes stability. It likes evolutionary change. And so at least from my point of view, that's what's paramount to the average American, is that we ensure that mortgage rates stay stable, that they have the ability to plan around it, that education costs stay fixed, and you don't have a lot of interest rate volatility.
Let's talk a little bit more specifically about your business on Walnut Street. I want to ask about M&A. I know that on your earnings call last week, you pointed to a recent acquisition by Huntington Bank as an encouraging sign. What does that mean for your own strategy as you evaluate the landscape?
Yeah, I think what was encouraging about the acquisition that Huntington announced was the confidence that they expressed that they would get a quick approval. It's not good for anybody, but in particular the customers of banks who are involved in mergers or acquisitions, for there to be any uncertainty about whether an approval will arrive and how quickly that approval will arrive. So I did think it was quite encouraging that they expected that they would get a relatively speedy approval. As it relates to our strategy, we're fortunate. We have really strong profitability today. I think we finished the earnings season #1 in ROE and #1 in efficiency among our peer group, and in the upper half in terms of year-over-year revenue growth. So if there are no acquisitions for Fifth Third, things are going to be just fine for shareholders. But we have the least consolidated banking sector in the world here in the U.S., and banks are the least consolidated sector of any major U.S. industry. So there is going to be more consolidation over time. And I actually think that's a good thing for people.
Tim, there's a recent story in American Banker that I appreciated on why one regional bank is excited about stablecoins. Now, when the Stablecoin Genius Act was passed in Congress, there was a lot of concern about what it would mean for the regional banking system. Why are you not afraid? Why do you think that this is a good solution?
Well, I think you have to wake up every morning when you're in a period of technological change and make a choice between being afraid because the old ways of doing things are going to become less relevant, or being excited because you're going to be able to improve the way that you operate or the quality of services that you provide to clients. So I tell our folks all the time, if you want the future to be interested in you, you got to be interested in the future. And we are excited about it. From my point of view, we run a massive payments operation. We clear over $17 trillion a year in payments for folks. And anytime there's innovation on payments infrastructure, payments rails, it's a good thing for us because it means we have new services that we can offer to clients. We can take friction out of their businesses. And I think the thing I'm most excited about with stablecoins as it relates to our operations is just the ability to clear cross-border payments for folks, who today would have to rely on Fifth Third referring them to a correspondent bank in many cases, and who would take currency risk, because of the delay in settlement and otherwise. Mm-hmm. So it creates an interoperability solution for multinational payment flows that just doesn't exist for a bank like us today.
Well, that's a really refreshing note to leave it on. You can't ignore innovation. You have to wake up every morning and take a look at what's going on. Tim, got to leave it there. Really appreciate your time. That is Tim Spence of Fifth Third Bank. Meanwhile, let's take a look under the hood at some single stocks moving this hour, and we start with CSX. That's a railroad operator rising on a report that BNSF is exploring a takeover of a rival. Perhaps that CSX. It seems that Warren Buffett poured some cold water on that, but certainly the sell side getting excited over the possibility.
The sell side is excited about the possibility. Hopefully the target needs a banker because Warren Buffett typically does not. Coca-Cola, I think this is interesting. Another discerning set of investors in terms of earnings season. They did beat estimates. They say cane sugar is coming this fall. Not enough to get people excited. Remember, in the Coca-Cola Pepsi pair trade, you actually had Coca-Cola running up more this year because of their domestic exposure versus Pepsi. So fun little fact, Pepsi actually doing better than expected this quarter.
There you go. We'll see if that mean reversion persists. Let's talk about NVIDIA, though. Shares down about 2.6%. Magnificent Seven stocks in general under pressure this morning. Remember, we get results from Alphabet and Tesla tomorrow afternoon. Maybe that will reset the narrative.
We will be waiting with bated breath because really we are just getting started with this earnings season. Coming up next, though, we are going to switch gears. We are going to talk to legendary venture capitalist Alan Patricof. He's on a mission to improve our golden years. And we're going to talk about AI and longevity next. This is Bloomberg Open Interest.
So today, are you confident that we can, with GLP-1 drugs, actually conquer and overcome the obesity problem
I think this is the beginning of control of body weight in much the same way that blood pressure was controlled over the years. We're having unprecedented success in treating patients now with the older medicines and the new generation of medicines. If you look at the earlier generation of medical treatments, we were able to get 2/3 of people to lose 5% or more of their body weight. With the latest generation, semaglutide and tirzepatide, we're getting 90% or 95%.
That was a peek at the first episode in David Rubenstein's latest series, Longevity, that premieres tonight at 9 p.m. on Bloomberg TV. And the legendary venture capitalist Alan Patricof knows a thing or two about longevity. For the past 5 years, the 90-year-old co-founder of Greifeld has been trying to redefine the science of aging with his venture firm Primetime Partners. It's a fund that invests in longevity technology. Now, the last time Alan was on with us, he said he planned on living to 114 years old. I'm pleased to say that Alan joins us now. Fantastic to have you back with us. And I want to talk about the landscape because you started Primetime 5 years ago, and I think it's pretty fair to say that it was a nascent industry at that time. You fast forward to 2025. How has the industry as an asset class and how has the opportunity set changed?
Well, first of all, I don't think we call it an asset class. I mean, that would be a little too much. I think that when we started 5 years ago, it was a few firms like ourselves existed, and no one was really focused on it. Today, jump 5 years, today there isn't a week that goes by that there isn't a conference, there isn't an article, there isn't a program on television like yourselves. And interesting that David Rubenstein's doing this special series on longevity tonight. So we have come a long way. I don't think we're at the point of an asset class. I think it's a subsection for a lot of the larger firms. Longevity has become a subsection of the healthcare area. But also longevity not only involves healthcare, it involves financial security, for people to really be able to live longer and have the assets to do that. So that's one of the areas to focus on. And the other, of course, is enjoying living longer, staying healthy, and being able to do interesting things and keeping yourself active.
This is also something that really meets the demographics of the country right now. It's an aging population, and solutions to meet the needs of the population are also very necessary at this time. For somebody who's kind of looked ahead and started investing in this space, what are the types of companies that will start to succeed more and more as it's clear that people really, both families as well as caregivers, need more support?
Well, I think you're right on the button. I mean, there will be more people living over in the next 10 years over 60 than there will be under 18. So we're going to have an aging population. It's not just for this country, but we recently were down in South America. They're very seriously dealing with the problem. Whenever we think of aging, we think of China, Japan, Europe. So it's happening every place. And I think that the challenge of caregiving, the challenge of delivering medical advice to rural areas in particular is a challenge. If people are living longer, we've got to figure out how to take care of them, how to keep them well and service them, and to have the hospital and medical facilities as well as financial products that will enable them to live longer.
I'm glad that we're talking about caregiving because you mentioned longevity, and I think most people just think, okay, we're in the business of living longer, but caregivers too are oftentimes an underappreciated part of this industry. And I know that you've invested around that fact. When you take a look at some of your portfolio companies, Carewell, for example, is focused on those caregivers.
Absolutely. I mean, caregivers are, you might say, unsung heroes. They're people who are devoted to the patients they have, sometimes 24 hours a day. They have to provide all kinds of services and also emotional support. A company like Carewell is focused on the products that elderly people need, and which run a whole myriad of items, not just the obvious, which are, of course, diapers and bedpans and all the kind of support devices. But as you get older, you need different kinds of products to keep you functioning. And Carewell, as you picked out, is a leading supplier. And it's not the same as going on Amazon and asking for a product and getting well, first of all, you're not going to speak to anybody. It's going to be through some kind of internet connection. But in Carewell, you're probably dealing with a particular person who can analyze the problems and understand better what you need. And it's a much warmer feeling and more comfortable for the
Alan, I also have another question about another portfolio company that I'm very eager to ask you about, given what's going on with Medicaid in the wake of the discussions in Congress and the big, beautiful bill. And Sheer Health is a company you've invested in as well, where health insurance and medical billing is front and center. How has the demand for these types of services surged this year?
I don't think it's fair to say they've surged. Sheer fills a very important need. We all get medical bills, and I don't know about you, but you probably don't have that problem at this stage. But certainly, if you're in a Medicare or Medicaid position, but even if you have just plain old bills, it's very hard to analyze. And what Sheer does is using AI and using every technique possible, it analyzes your health bills and shows you how to recover excess money that you may have paid and how to avoid costs and to do it in the most efficient way. And it's meeting a real need. And I'd say certainly it's growing. But I think we really have not even seen the tip of the iceberg into how much that company can grow.
Alan, we appreciate your time today. I know we've talked about this a lot offset too, so excited to have you on to share this with our viewers. That is Primetime Partners Chairperson and co-founder Alan Patricof. Katie, you also have been focusing on artificial intelligence in the healthcare world, and I think David Rubenstein is too.
Yeah, I'm really excited to see the premiere of this. That is premiering Longevity with David Rubenstein tonight at 9 p.m. New York time. And I know that Alan wouldn't go as far to call it an asset class yet, but you think about how many people are interested in this, both from a personal level, I want to live longer, and also as an investable universe. And it's been really interesting to watch it change and evolve over the past couple of years.
Yeah, there are a lot of people who want to see this fixed, especially if you think about the big macro ramifications, the questions about retiring later to try to fix some of this gap, and also, you know, big asset managers trying to figure out how to make that retirement money last longer. So a lot of implications, Katie.
Absolutely. And coming up next, we'll continue to keep an eye on these markets. A lot of pieces moving on this chessboard. This is Open Interest.
What do you think your mark is going to be as the CEO?
The trend of private capital, as significant as we think it is, if we look back again to 2000 to today, it's early days for private capital. If you think about the big trends, demand for infrastructure, demand for energy, the demand for defense, and really what's happening geopolitically, the demand for private capital will only increase. I'm also generally an optimist. So I think industries will grow, investment will grow, and private capital will just grow to be a provider of capital.
Spent many years at Goldman, now he's leading Carlyle. You can find the interview with Harvey Schwartz tonight. It's the season finale of Bullish at 6 p.m. New York time on Bloomberg Television, or streaming at 8 p.m. on Bloomberg Originals. Join the 1.5 million people that have already been watching Bullish. We're excited to bring you what's been actually my favorite episode, if I could choose one, Katie.
There you go. Wow. Big tease for tonight then. You don't want to miss that one. 6 p.m. New York time on Bloomberg Television. Let's get a quick check on these markets while we wait, though. It's not too pretty. The S&P 500 down about 0.1%. It's big tech where all the weakness is. The NASDAQ 100 down about 0.5% right now, Sonali.
Getting a kick out of the Treasury Secretary taking his foot off the Powell pedal and the 10-year yield being a little bit lower. Stick with us. We have a big show tomorrow. Anastasia Amoroso, David Gross of Bain Capital, and of course, preview to earnings.